everybody. Welcome to P.B.M. Money. And I want to warn you up front, this one might run a little bit long. I want to talk about my view of the state of the market. Now, everybody's got an opinion, and I've heard them all. I've been paying very close attention for a while. I've touched on this topic before, and I want to start by saying I am not a stock advisor, I'm not a financial counselor. This is just a guy talking, and this is my opinion based on what I know and what I've seen and what I've experienced. Now, right now, as we sit here and chat, the state of the stock market appears to be great. The stock market has gone up 50% in just the last couple of years. As early as 5 years ago, the stock market was at 19,000. It is now at over 31,000. For each 1,000 points, that represents $1 trillion in investment. Okay? Now, there are some things that have contributed to that. The stock market took a big jump when Trump came into office because he set the fundamentals the way they needed to be. This is not political, it's just a fact. When Obama was in office, it was the beginning of a bull market, but it was 1 or 2% at a time. There was no big run-up. When Trump came in and he took off the regulations, brought countries back, added tariffs to imports, closed the, when he did all of those things, the stock market went crazy. We've had the V-shaped recovery after the pandemic, with the exception of the blue states. It dropped off really quickly, and if you look at the stock market, especially if you've been buying in the market, you know that those growth stocks are fewer and far between. They were a dime a dozen a year ago. So they're coming back very quickly. Also, the unemployment is still up. It's nowhere near where it was, but it's around 6 or 7%, I believe. And the government has done a lot of stimulus and unemployment benefits to the tune of trillions and trillions of dollars. The last one alone was 2-point-something trillion. They've dumped a lot of money in this economy, and people have gotten the money and they don't know what to do with it. Do I pay bills? Do I invest? Do I play in the market? What do I do? So going forward, what do I see that could affect the market? And let's think about some of them. Inflation. Now, most people, when you think about inflation, and I remember when Jimmy Carter was in office, before scanners, we'd go to the store and just like a can of vegetables, we would dig back to the back of the shelf, and there would be 3 different prices from the last time we were at that store, a week. So within a week, prices had gone up 3 times, and they were changing so fast that the clerks didn't have time to pull everything off the shelf and reprice it. So you got the stuff that was in the back because they didn't pull it forwards, and that was usually the cheapest stuff. So I remember that. So when people don't see that, they don't think that inflation has happened. It's happened. It's here. The problem is that the retailers and the wholesalers are hiding it in the guise of other things, because we've been preoccupied with the pandemic, with the states closing down. See, when the states closed down and people didn't go out, they didn't recognize that the prices went up. A year later, people are getting out, prices are up, they don't recognize it. Prices have gone up. Have you tried to price lumber lately? Have you checked your grocery bill lately? I went to buy a single one steak, and it was a T-bone. Nothing to write home about, not super thick, not super thin. 15 bucks. 15 bucks for one steak. I can go out to a restaurant and get it cheaper than that, cooked for me with sides. Unbelievable. So going forward, I see no more stimulus happening. So the excess money that the Americans had to go blow in the market and play in crypto and collectibles and all that, that's going to go away. Savings rates are at the highest they've ever been. Those are going to go down because people are still out of work, and as the stimulus money dries up, the as the stimulus dries up, the money for the market will dry up, which means the prices should go down. Since Biden has been in office, he's been going through and undoing all the policies that Trump has done. And because it's on such a bull run, it hasn't paid attention yet. And it probably won't for 6 months to a year when it catches up. For right now, starting now actually, businesses, the stock market should start reacting more to business balance sheets. And as those regulations start to take effect and it affects the bottom line, again, that's going to be a downward push on the market. Now, business is moving again. I don't know what our GDP is the last time I looked. I'm guessing that it wasn't quite where it was, but it's doing very well. I can just tell from around here things are picking up, and I live in a blue state. Another thing that has happened is the open border. Again, because of presidential policy that's in effect right now, the border is being pummeled. Absolutely pummeled. Hundreds of thousands of people every week are coming across our border and flooding us, which means more money to be spent on illegals, lower labor costs for Americans, and all of that translates into less money for investment, less money for us to spend in business, and that translates into lower prices on the stock market. There are about a dozen blue states that are still shut down, and when I say shut down, I mean California shut down. California, Wisconsin, Illinois, New York, New Jersey, and there's some other ones. They are shut down. Restaurants are going out of business left and right here in Illinois. Businesses are leaving and heading to Mexico, going back overseas because of the policies. That all translates into less tax revenue for the government. Less tax revenue for the government means less money that they can pump back into the economy without going into debt. And as the debt gets higher and higher and the revenues gets lower and lower, again, we're looking at inflation and inflation that will affect our pocketbooks, our costs. The grocery stores, automobiles, houses. The housing market right now is going crazy. They're blaming it on low interest rates, so everybody's rushing to the store or to the bank to finance right now. I don't think that's all that's at play here. I think the Fed could allow those rates to go up and the housing market would still boom because there's inflation. But they're not calling it inflation. government intervention in the stock market and in the business world is going to increase, not decrease. It's going to increase. And I'll tell you one thing that I have learned in my lifetime, and that's this. Anytime the government says, I'm here to help you, batten down the hatches and grab your wallet. The Fed has said that he will not allow inflation to happen. And he's going to use, the main tool that he's using is to buy U.S. securities. All right, great, go have a good time with that. The problem is, at some point, we're going to have to stop buying treasuries and start selling treasuries. There is never an endless supply of money that has value. There's an endless amount of paper and ink that we can print, but at that point it'll be just like during the Civil War. People were using paper money to wallpaper their houses because it had no value. Just like in Venezuela. You know, they're taking a wheelbarrow full of currency to go buy a loaf of bread. All of those things that I just mentioned are all negative when it comes to the market. It all spells crash. So what do I see for the future? Well, most of the things I have told you up to this point have been facts. Now I'm going to give my opinion. I still see 1 to 2 years of growth, and maybe even a growth spurt in a year or so. Because we still have stimulus money out there. We still have some big states that need to open up, and as they open up, unemployment will go down in the short term. Spending should go up in the short term. GDP should go up in the short term. So I see continued growth, not as much, but I do see some continued growth. Then after 3 years, or 2 to 3 years after that point, after all the states are all opened up and everything is back to normal, and we start relying on the financials from the businesses like we should have been all along, that's when the market's going to start to go down. Now, the government and the stock market have guards, not people that are guards with guns. I mean, they have guidelines and guard things to guard from a massive dip. As an example, after it drops so many points or so many percentage points, the market temporarily shuts off. You can't buy or sell anymore, and that's to keep a run from happening. But I have seen it when it's done that and they open up the next day and it picks right up where it left off. But it's a cooling off period. But I do think that we're gonna, when the growth stops, the states are open, and we rely on financials, when that starts to happen, the market will start to go sideways. Then it'll start going down a little bit, and it'll take periodic drops, down, 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 until we wake up one day, and I think it's going to go as much as 40% down. That's just my opinion. Now, history says that when the market crashes, and it will, the market will go down, by the way. That's not an opinion. That's a fact. It happens. It's just part of the stock market. It goes up and then it comes down. That's why they call it a bull and a bear. The bear market goes down, and history says that when the market goes way down like that, it usually goes down for 89 days. That's the average. I think it'll go down quicker and start back sooner, simply because of technology. Most of that history is based without consumer technology. There was industrial technology within the market and the players, but not with the consumer investors. But I think it'll happen quicker. But so after about 3 months of the market being way down, that's when you should start buying. And I think it will come back. So what do? Well, what I have done is I had all of my money in the market, and I have taken a percentage of it out and put it into the bank and left the rest in there. I'm still dollar cost averaging into individual stocks. Most of the money I took out was in my mutual fund. And I'm still going to dollar cost average into individual stocks. Well, at least for the next year, and we'll see what the market does. But if the scenario plays out as I see it, next year I'll take another percentage out, and then the third year I will take it all out and have it all in cash. And the only thing I'll have is money in individual stocks in the market, which I can trade instantly. If it's in the other, I have to rely on them to sell, and me being a little guy, I'm going to be the last one, and I'll take the biggest hit. But at least this way I'll have control over selling it, and I won't be, and as the market does grow for the next 2 to 3 years, I won't miss out. I'll still have money in there. I'll still get some growth. And if it goes down sooner than I think, I will lose some, but I won't lose as much because I don't have as much in there. So I'm trying to hedge my bets, still take advantage of the ups, and trying to minimize on the way down. Now, if the market goes down and you've done this scenario that I just played, here's what I would do. I would take a lot of cash and go hunt for real estate bargains, because if the market crashes and people don't have cash and they've lost cash in the market, there's going to be a lot of bargains on the market in real estate. And that is one way you can build wealth in a down market without waiting for the market to come back. Go put your cash in real estate and let it sit there, rent it out. Then when the market starts back and you know that the market is back, go refinance your house, pull some cash out, and get back in the market. That way when you come back, you've got now 2 assets instead of 1. Now, the reason I did this video is because I have been watching a lot of videos, and a lot of the ones that I have been watching have been millennials, and they all keep saying the same thing. Stay in the market, buy the dip, even if it loses 30 or 40%, still buy. Okay, first off, as a general rule, I would say that's accurate advice. However, if you're over the age of 50, that advice is not good at all. That's bad advice. Because if you have your money tied up in stocks or in the market and it goes down, your retirement is at stake. I remember, let's see, that would have been in the 90s. The market went down and Ford stock wasn't worth the paper it was written on. Inflation was up. I mean, all the numbers were bad. And I was selling insurance at the time, and people had lost everything. And 5 years later, I would go back and see these same people, and they were starting to come back, but they were still down 20–30%. It takes a while to come back once you've lost it. It will come back, and history says that. But if you don't have 10 or 15 years to wait on the market to come back, you need to have a different strategy than buy and hold and buy the dip. And that's why I made this video. The advice people are giving is suitable and accurate for long-term investors, which means if you're in your 20s and 30s and early 40s, that's good advice. But if you're in your late 40s, 50s, 60s, and older, that's poor advice. The older you are, the more aggressive you need to be right now to get out of the market. This is the longest bull market we have had in history. And we know for a fact that a crash is coming. We just don't know when. The millennials keep telling you it's not going to be a crash, it's going to be a correction. I'm sorry, that's not accurate. History says that is not accurate. The market, I don't think the market has ever gone up 50% in several years, and when it went down, it was only a correction and kept going. No. It's going to go down drastically, it's going to go down substantially, and it's going to go down enough to stay down for a while. The question is, are you going to be prepared? The younger you are, the more risk you can take. The older you are, the more aggressive you need to be to protect your assets. Now, if you've got your money tied up in things that you can't readily cash in without penalties, then you need to contact the people that are managing your fund and say, hey, move all my money to the most conservative thing you can find, bonds. Put it in bonds. But get it out of the market, at least until the crash happens, and then go back in. I am only in my early 60s, so I'm not that aggressive, but I am going to be aggressive to get the money out of the market. And if I make it and don't lose anything, I'm just going to keep it in the bank until the crash happens, and it will happen. And if it doesn't happen till after I die, okay, then I'll die with a bunch of money in the bank. I'm okay with that. But if I were younger, my advice would be completely different. If I were younger, here's what I think I would do. Whatever I'm buying, whatever I'm spending right now in the market, let's say, just for the sake of argument, let's say you're investing $100 a month. Okay? I think what I would do is I would half that. I'd put half in the bank and half in the market. And here's why. Because when the market goes down, and it goes down 30, 40, 50%, and it starts to go back up, if you've got your money tied up in stocks that are way down, you're not going to be able to take advantage. If you put the money, half of the money, in a savings account, when the market starts to go back up, you'll have 2 or 3 years worth of cash that you can now go in and buy some cheap stocks. I would not continue the same amount of dollar cost averaging. I still would, but I would not put that much in. I'd put half and half. Just my opinion. Well, that's about all I wanted to talk about. I hope you enjoyed the video. I hope I was able to help you. And yes, I did run a little long. Not as bad as I thought, though. But I hope it was helpful. I hope you at least give some thought and not just take the advice of everybody you're hearing on the internet. Me also, go do your research and let me know what you think. Well, you guys have a great week and happy and safe investing.